our momentum trend metrics. Price, meanwhile, on the S&P and NASDAQ, you could say, well, it's having a drop, no big deal. It's a correction, buying opportunity. But by our quarterly momentum trend metrics, which is a long-term metric, and it doesn't say, oh, you're going to go down for 2 weeks. It says you're likely to go down for, a year or so, maybe more. We broke structure. We broke it in January, but NASDAQ stubbornly wouldn't. NASDAQ 100. It broke it about a month ago, above current levels. And I think what's going to lead to is a layered slab by slab decline, not necessarily a crash event, which means 35% in 2 weeks, okay? But more like, 10, 15%, then, oh boy, it's a buying opportunity, then congestion, then another 10, 15, et cetera. But during that process, money goes elsewhere. If you go back through history and study 29 through 32, or study the mid-70s to the 74 collapse in the stock market and the wasteland that followed, the 2000 dot-com top, the 2007 top, and look what gold did during that time, up. Okay, so did T-bonds, by the way. There's potential for T-bonds to try to tag along with gold here briefly. Not a place to be long-term, for sure. But the issue is not whether the gold and the gold stocks and silver are going to advance. The issue is now, with that breakage in the stock market and the flow of money elsewhere to safe places, the gold and silver and the miners are going to go up more aggressively. Which what we've seen since March of last year is a layered, confusing advance where many people 3 or 4 times got scared out of the market, the gold and silver market, and it didn't mean anything. And again, recently they sold the $35 level of silver. Now we get back to 35 again a month ago. Now we're back to above 35. Okay, so they keep selling these levels, and it stops it for a while. Same with gold. I think we're about to enter acceleration. And I think the acceleration is going to be most notable in silver and in the gold and silver miners, with Mama Gold sort of leading the way, but not performance-wise anymore, percent-wise. Trend, yes, but the swing to the upside in silver and the gold miners now will be slingshot-like, where they get out in front of gold in performance terms. And it's the better place to be, I think, this year. We've had in the prior 2 gold bull markets over the last 50 years, both of which were 8-fold advances, bear low to bull high. Right. We do an 8-fold advance, gold is going to be $9,000, okay, because we started from 1,050. And that merely replicates the dimension of the prior 2 big bull markets in the last 50 years. But if you look at the action in the last year, or even the last several quarters of each of those bull surges, the one that peaked in 1980, $850 gold, silver is $50. Or look at the one in 2011. Much of the percent gain occurred in the final year, or actually in the final several quarters. And it's at that point silver went berserk in relation to gold. We've got reasons to believe, and this is not gut level or, just looking back at the past. There's technical reasons when we assess the performance trend of miners versus gold and the performance trend of silver versus gold and plot it technically as a spread and then run momentum studies of it. It says to us that the pullback we saw in performance since that surge in mid-2020 when silver and the miners beat gold handily during that big boom, But in the years since, they've retreated on a relative basis. Silver's more or less gone sideways, actually. It has not lost ground to gold, but it hasn't outperformed. And the miners have actually lost performance. Those charts tell us that we're in the upturn phase now, out of that period where those categories of the monetary metals underperform gold. They're now about to shift to outperform. So it's a technical assessment. And I think that will be coincident with an acceleration in price of the entire complex.
Got it. So I want to go back to the miners, but real quick with silver here. You gave me a projection on gold. Correct me if I'm wrong. You said we're looking at about 8-9 grand on the upside.
That's not a target. It's not a target. It's just simply stating prior to realities. And you, as an investor, can decide whether he thinks the reality today is similar to those, or is it far more dramatic? And I think it's going to be more dramatic, and not just here in the U.S., but globally, in terms of especially government debt crisis. We're watching commercial real estate for a debt crisis, not mortgages, but commercial real estate, and hence, therefore, the financial sector. I know everybody's looking at NVIDIA like that's the be-all and end-all, and no, it's not. Look elsewhere. But when that stuff hits the fan, the panic mode and the emotion involved in markets will shift dramatically. And I think it's already beginning to where you'll see miners do things on the upside that are just jaw-dropping in terms of gain and speed of gain.
Today, we are diving into a crucial topic that is shaping the financial landscape, the current state of the markets. Now, I'm sure many of you have been keeping an eye on the S&P and NASDAQ, and you may have noticed something curious. The markets have been showing some signs of a decline, and you may be tempted to brush it off as just a correction, a natural part of market cycles. You know, the typical buying opportunity we hear so much about. But let me tell you, it's much more than just a correction. In fact, according to our quarterly momentum trend metrics, which is a long-term indicator, the situation is far more concerning than what you might be hearing on mainstream financial news. These metrics don't just look at short-term price movements. They track longer-term trends, and based on this, it's clear that we've broken structure. And when I say structure, I mean the foundation of the market itself. This break happened back in January, but the Nasdaq, particularly the Nasdaq 100, has been stubborn. It only broke its structure about a month ago, and while we are seeing some rebound, we're not out of the woods just yet. Here's the key takeaway. This doesn't look like a typical 10 to 15% drop followed by a rebound and a return to the old highs. No, this looks more like a layered slab-by-slab decline. You won't see a crash of 30 to 35% in just 2 weeks, but instead, we might experience a steady decline, say 10 to 15%, followed by a temporary buying opportunity and then more stagnation or another round of drops. It's a drawn-out process, a slow bleed, and during that time, money will start flowing out of these markets and into safer assets. Now, before you dismiss this as a worst-case scenario, let's take a trip down memory lane. If we look back at history, particularly the period between 1929 and 1932, the mid-70s collapse, the 2000 dot-com bubble, and the 2007 financial crisis, we see similar patterns unfolding. In each of those periods, as the stock market was in turmoil, the money didn't just disappear into thin air. No, it found its way into gold, silver, and precious metals mining stocks. These assets performed extraordinarily well during those crises, and we have every reason to believe that history will repeat itself. But here's the thing. When it does, it won't be a slow trickle. It will be an acceleration. Take a moment to think about the role of gold in these market shifts. Gold is a timeless store of value. It has consistently risen in times of uncertainty, and it tends to outperform equities when market sentiment turns negative. We saw this with gold's performance during the 2007 to 2008 crisis, and we saw it again in 2020 as the world grappled with the onset of the pandemic. But we're not just talking about gold. We're talking about the entire precious metals complex, which includes silver, miners, and other commodities. What we've witnessed in the past year with gold and silver is an interesting development. They've had several false starts, with many investors getting scared out of the market multiple times. Gold and silver prices would surge only to retreat. And yet, despite these corrections, the upward trend has remained intact. Gold recently hit $2,000 per ounce and held strong, while silver rebounded above $35 per ounce after dipping lower. Now let's talk about silver for a second. Silver has had a particularly interesting relationship with gold. In past bull markets, silver has often played catch-up, initially lagging behind gold, but then surging ahead and outpacing it when the rally accelerates. We've seen this in both the 1980 bull market and the 2011 bull market. In those instances, silver shot up to levels many thought were impossible at the time. And here's the thing. I think we're on the verge of something very similar. Silver, and particularly silver miners, are positioned to outperform gold in the coming months and years. I'm not just throwing this out there based on gut feeling. No, we've done the work. We've analyzed momentum trends and technical patterns that suggest silver is in the early stages of a significant upward move. Silver miners, too, are showing signs of strength, and they have the potential to greatly outperform gold. But this is not just about price. It's about the broader trend. When we look at the performance of precious metals in times of crisis, and especially when market sentiment turns negative, these assets become increasingly attractive. The shift in investor psychology is palpable. As equities decline and the broader market environment becomes more uncertain, people will flock to safer assets. And that's where gold, silver, and the miners come into play. If you've been following these markets for any length of time, you'll know that the bull markets in gold and silver are not linear. They tend to be highly volatile, with significant pullbacks along the way. But once the upward momentum gains steam, things can get really exciting. We could be in the early stages of a multi-year rally that could lead to jaw-dropping price moves.
My emphasis is the gold and silver miners, either via GDX, the basket, double GTX, and silver miners, specific ones. And a handful of them, and I'm going to expand it. So at this point, at this juncture where I think we're about to accelerate, my emphasis is not to be fully invested, because I am, but to shift the investment around and lessen my straight bullion position in gold and move it over more to a silver bullion or a double silver bullion position, and or into the silver miners, because I think the geometry there could be jaw-dropping in the miners.
Or torque, yeah.
Because historically, they are so beat up, historically, compared to the price of gold. Like XAU index is an example. It's been around since the 1980s.
Mm-hmm.
It used to trade as a relative percent of the price of gold in a range where you divide XAU price into gold price. In a range from the 1980s, 1990s through 2008, okay, so 20, 30 years, in a range that had a low end 17.5% and an upper end at 35%. So let's call the middle, let's say 25%. So XAU would do this over that 30-year period, but generally around 25% of the price of gold. It collapsed to 4% of the price of gold during the 2015 bear low, when it bottomed coincident with gold in net price. Right now, it's about 5.5%, a little higher probably. It's been in a 10-year wide range on the spread, not up there in the 17 to 30% level, but in the 4% low, and basically 5 to 8% doing this for 10 years, meaning holding its value versus gold, but at extremely low relative levels, historically speaking. If you look at that chart, and we've sent it out in our reports, and look at the bottom end of that 30-year period where it was 17.5 to 35%, and draw a line through all those lows that prevailed for several decades. That means you break this spread out, technically speaking, you could run up and bump your head on the bottom side of that multi-decade range, which is technical resistance, right? Okay, boom, the bottom of the old, what had been a floor, and you could stop there if you want. That's a tripling plus of the current value of the miners relative to gold. And we're seeing emergent breakout now, this month, on this month, that suggests we're coming out of this base, of this performance base, which is again very subdued. The top end is only 8%. And 17.5 used to be the bottom end. So decades ago. So we could get an extreme explosion out of the gold and silver miners, and the reason being coincident with the breakage in the stock market. A lot of investors don't want to go out and buy silver bullion or futures or things like that, or buy leverage call positions. They just want to buy miners. Some of these miners, after all, have pretty good dividends, okay? Some of the biggies. And so they'll move the stock category, most of the stock categories, which will go south, and move into the categories which are going south. The one of which will stand out is the gold and silver miners. I've used the wet bar of soap analogy. Everybody's grabbing for the wet bar of soap, and it shoots up because it's a tiny, tiny little sector, dollar-wise. And even a small amount of money moves over, it could be a panic explosion.
As we continue to examine the unfolding financial landscape, it's crucial to dive deeper into a sector that's often overlooked, but which has massive implications for the broader financial markets: commercial real estate. When people discuss debt crises or financial crashes, they typically focus on residential mortgages. But the situation with commercial real estate is significantly more precarious. At this moment, commercial real estate is facing a perfect storm. The shift to remote working and hybrid work models has already begun to disrupt the commercial property market, particularly in major cities. This is no longer a passing trend, it's a structural shift. Companies are downsizing office spaces, leading to higher vacancy rates in many markets. In the past, office buildings and retail spaces were reliable sources of income, but today, they are becoming increasingly difficult to lease. The effects are even more pronounced in retail real estate, where consumer behavior is shifting toward e-commerce and away from physical stores. The next piece of this puzzle is the debt attached to commercial real estate. There is massive leverage in the sector, as real estate developers and property owners have borrowed extensively to fund their projects. However, With reduced demand for office space and higher vacancy rates, the ability to service that debt is deteriorating rapidly. Many businesses that own or invest in commercial properties could face defaults on their loans. When commercial real estate begins to implode, it will create significant stress in the banking system, as many financial institutions hold large amounts of commercial property debt. We've seen similar dynamics before. In fact, commercial real estate played a pivotal role in the 2008 financial crisis. While residential mortgages were the primary focus of that crisis, commercial real estate also took a hit, and this time around, the situation could be even more severe. As more companies downsize or shift to digital-first models, expect the real estate market to face continued pressure, especially in cities that were once thriving hubs for corporate offices and retail outlets. What does this mean for the broader financial system? If commercial real estate continues to decline and defaults on loans begin to mount, we could see a domino effect. The financial sector would be at risk, especially regional banks that hold significant exposure to commercial properties. If these banks are forced to write off bad loans, it could trigger a wider credit crunch, causing liquidity problems and further destabilizing the financial system. The ripple effects of a commercial real estate crash could send shockwaves through the economy, as we saw with the 2008 crash, but on an even larger scale. As if this weren't enough to be concerned about, let's take a step back and consider the broader financial environment. The global debt crisis is escalating. Governments around the world have been ramping up borrowing to deal with the effects of the pandemic and the economic fallout from it. The reality is, many countries, including the United States, are running up unsustainable levels of government debt. In the US, national debt is now over $30 trillion and climbing. While governments can continue to service this debt for now, there comes a point when the interest payments on such a huge debt load become unmanageable. This is not just a US issue either. Countries like Japan, Italy, and China are facing similar challenges, with massive debt loads threatening to destabilize their economies. When a debt crisis finally hits, it's going to force markets to reevaluate their risk. Governments will have to make difficult decisions about how to manage their debt, and investors will begin to question the stability of sovereign debt markets. In this environment, precious metals become incredibly attractive. As the financial system begins to wobble under the weight of this massive debt, investors will flock to safe havens. We've seen this in the past, and we're about to see it again. As the stock market loses steam, as commercial real estate suffers, and as government debt problems intensify, gold, silver, and precious metal miners will become the go-to assets. But let's not get ahead of ourselves. We're not at the full-blown crisis stage yet. However, when that moment comes, it's going to shift investor behavior in ways we haven't seen in a long time. The panic mode will set in, and that's when we'll see money pour into safe haven assets like gold. It won't be a slow trickle either. It will be an avalanche of money flowing into precious metals, driving up prices in an exponential manner. Gold, as we know, has been the go-to asset during periods of crisis, and this time will be no different. Now, we're not just talking about a small move here and there. We're talking about a full-blown bull market in gold, a market that could push gold's price up significantly. We've seen massive bull markets in gold before. The last major bull market in gold was between 2001 and 2011, when gold surged from around $250 per ounce to over $1,900 per ounce. Similarly, gold saw a significant rise during the 1980s, driven by inflation fears and geopolitical instability. But this time, the dynamics are different. We're not just talking about the traditional factors that drive the price of gold. Yes, inflation is a major factor, but there are also growing concerns about geopolitical instability, currency devaluation, and the implosion of the global debt bubble. As governments around the world continue to print money and increase debt levels, the value of fiat currencies will be further eroded, making gold even more attractive. Silver is going to play a big role in this dynamic as well. Throughout history, silver has had a strong relationship with gold. While gold has often been the preferred store of value, silver has been used more as an industrial metal. However, when investors turn to precious metals, silver tends to play catch-up with gold. This is exactly what happened during the 2011 bull market, when silver went on an incredible run, far outpacing gold in terms of percentage gains. It's likely that we'll see the same thing happen again. Silver will outperform gold in the coming bull market, and silver miners will likely lead the charge. Now, this is where the miners come into the picture. precious metal miners, particularly silver miners, are poised to outperform in the coming years. Over the past several years, silver miners have underperformed relative to the price of silver itself. But if you look at the technical charts, you'll see that this is about to change. The performance trend of silver miners compared to silver is showing strong signs of turning upwards. In fact, we're already starting to see the early stages of a potential rally in these miners, and once the money starts flowing into them, the gains could be staggering. The miners are often the best performing assets during precious metal bull markets, and they have the potential to outperform the metals themselves. This is where things get really exciting. Because if silver and gold go on the kind of bull run we expect, miners will be the ones to lead the charge. We could see massive gains in a relatively short amount of time. In fact, many of the top-performing gold and silver miners could see their stock prices multiple in a matter of months, as the global debt crisis and broader financial instability drive capital into the precious metals sector. But let's not lose sight of the bigger picture here. We are on the edge of something much larger. We're talking about a global debt crisis, an impending economic slowdown, and a market that is being forced into a paradigm shift. The stock market, particularly the tech sector, is looking increasingly vulnerable, while gold, silver, and their miners are well-positioned to benefit from this turmoil. And remember, this won't be a quick, clean rally. It's going to be volatile, with pullbacks along the way. But the overall trend is clear. We're in the early stages of an explosive move in precious metals, and when it takes off, it's going to be incredible. So, as we head into the next phase of this crisis, don't be fooled by the short-term noise in the markets. The real opportunity lies in the precious metals space, particularly gold, silver, and miners. Get ready because this is just the beginning. The next bull market in precious metals will be unlike anything we've ever seen.
Stay informed about the latest developments shaping the precious metals market with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.